when the gallon of gas where I live reaches above $5 per gallon, an increase of over 80% in cost in a single year. Damn! It seems to be a topic of conversation all the time. Not just gas, but the basic cost of living has skyrocketed. Not only in US, but all over the world. People all over the globe are continuously stressed and overwhelmed at increased cost of living. Everything seems to be double in price, from the gallon of milk to the basic loaf of bread. To fight this rapid inflation, governments worldwide have been increasing the interest rate. The American Federal Reserve has already increased the interest rate by 25 basis points on March 16, 2022, and another 50 points on May 4th, and then again this past Wednesday, June 15th, another increase by 75 basis point rate, the highest since 1994. And how increasing the interest rate can help with inflation. This is going to be our topic today on Money Mindset. I am Sohaib. Strap in, grab a cup of coffee. This is going to be a spicy ride. There are two main reasons for the recent insane inflation. First one is the supply and demand imbalance that's impacted after the COVID-19 pandemic and the recent Ukraine and Russia war and its implication. Okay, let's start from the beginning. Inflation is a gradual rise in the price of goods and services. It lowers the value of currency units, such as US dollar, resulting in greater living costs. Imagine how much it would have cost you to rent an apartment in New York in 1970s. Then, how much it would cost you now. That price level increase is inflation. Inflation is usually caused by increased production costs or rise in demand for goods and services. Inflation has always played a major role for consumers and investors, from used cars to the housing market, the stock market, and beyond. Increased production cost, also known as cost push inflation, which means prices rise due to rising production cost, such as raw material and labor, or commodity prices such as gas and metal. Okay. Let's look at a real life example. The Ukraine and Russian war have led to many political stressors between nations and Russia. This has led Russia to cut off its global supply of gas to the world, ultimately decreasing the supply chain of gasoline and therefore increasing the gas price, which lead to increasing the cost of all goods that require gas in production or transportation to transfer goods. Ultimately, this political decision has impacted the global international commerce because of the increasing gas price will eventually lead to increasing in the production cost.
Are you serious?
Strong consumer demand for a product or services can lead to demand pull inflation. When demand for a wide range of items increases across an economy, their prices tend to rise. For example, home prices have increased dramatically in the previous 2 years. The main cause of this is the high demand. Demand pull inflation.
Skyrockets in flight.
To understand the recent inflation, we need to go back with the time 2 years ago.
Time travel.
After the COVID-19 pandemic, the global quarantine, and unemployment, governments were concerned about recession, which made them providing individuals with stimulus checks and unemployment benefits, so people can go and purchase products. Yes, helping the families and businesses, but also preserving and maintaining the economic market, because the transaction between consumers and sellers was still occurring.
Fantastic.
Furthermore, the American Federal Reserve lowered the interest rate, so it became less costly for companies and businesses to borrow money, assisting businesses to stay afloat and maintain their employees and production, to sustain the movement of the economic wheel during pandemic. So now we're understanding inflation and where it comes from, but how does increasing the interest rate help with inflation? Inflation and interest rates are intertwined because interest rates are the primary tool used by the Federal Reserve and the US Central Bank to manage inflation. A little shift in interest rates can have a significant impact. The economic wheel has been turning consistently for the prior 2 years, standing against the economic recession that might have occurred due to COVID-19. A majority of individuals were able to maintain their lifestyle and they were able to borrow more money. This has created an imbalance in the supply and demand ratio. More individuals can easily borrow money to buy houses and cars with slower interest rate. But on the other hand, there is not enough supply for those purchases. Either not enough production or supply chain shortage and international shipping disputes. A higher demand and a lower supply of goods leads to an increase in price inflation.
Cry.
Raising interest rates discourage consumers and companies' expenditure by raising borrowing costs, particularly on big-ticket goods like houses and business properties. Also, raising interest rates tend to put downward pressure on assets values, reversing the health advantage for people and making banks more cautious in their lending decisions.
Really?
With this continuous inflation, the Feds must increase the interest rate, which will create two hurdles. First, borrowing money becomes more costly. Let's look at the housing market. An increase in interest rate makes it more costly to purchase a home, slowly decreases the demand. So the cost of homes slowly depreciates. This creates a shift in the supply and demand, slowly reversing the imbalance that had occurred. Individuals and businesses face other problems. That borrowed money faces higher debt. Therefore, they must run a tighter ship. Individuals will subsequently only purchase items that are needed, and therefore decrease the purchasing pattern to be able to repay the debt that they acquired. Just like individuals, businesses must begin to cut their expenses to be able to pay back their accumulated debts. Other problem that can be faced
That is enough.
is if the interest rate rises too much, individuals may not be able to pay back the debt. Also, companies can feel strained, so they begin laying off individuals, resulting in a recession or later a depression, which is completely other topic for another day. So with increasing the interest rates, people will start spending less. As a result, demands for goods will start decline, which will lower the inflation.
I got it.
Between 1980 and 1981, an excellent example of this happened. Inflation was at 14%, and the Feds boost interest rates to 19%. This resulted in a severe recession, but it did stop the country's skyrocketing inflation. So guys, this is how increasing the interest rate will help with inflation. Yes, definitely it will slow down the economic wheel and may put us in risk of recession. But personally, I'm not too worried if recession happened in 1 or 2 years while the interest rate is high. The Fed is gonna go to decrease the interest rate again, which will encourage the people and businesses to go and spend money again.
I feel dizzy.
Till next time, guys, stay tuned, stay safe.
Thank you.